Chair Powell is not going to wave the victory flag today.
I don't think he'll be inclined to say much about the short term and the outlook for the Fed funds rate.
Powell has to come out and reaffirm what the dot plots were saying, that there will be cuts in 2024.
I really don't think Powell is going to come out and make some kind of declaration that the Fed is done tightening.
What's really important is less what we're going to hear from Chair Powell and more the price action in response.
This is Bloomberg Surveillance, live from Jackson Hole with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Live from Jackson Hole, Wyoming, for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance on TV and radio. Alongside Tom Keene and Lisa Abramowicz, I'm Jonathan Ferro. 12 months on from the promise of pain from Chairman Powell. 12 months later, we're at the epicenter of soft landing hopes and dreams. TK, a few hours from now, Chairman Powell taking a stage.
A few hours from now, and maybe more than a few minutes, the zeitgeist this morning. The Bears are up early trying to get a game on the speech, and the rumor is a longer speech this year.
Longer than 8 minutes.
Longer than 8 minutes, which is large.
Lisa, what a difference from 12 months ago. The worry of unemployment surging to get CPI back down to 2%. And here we are with unemployment almost exactly where it was 1 year ago.
Does he reject the pain narrative? That's what I want to understand. Does he say we don't need pain to get where we need to get? We can actually get this soft landing. Well, but this is my question. If he sort of goes into this question of look at this, look at how we've really right-sized inflation, this could actually be exactly what we've never achieved before. I'm going to be more like Alan Greenspan and less like Paul Volcker.
Well, he may be more like Alan Greenspan. This is a really important point, and it goes to what a lot of the fancy math is maybe a new definition of what measured is. And maybe he'll address that within the speech. But I would suggest his major issue with UATA in attendance, Broadbent in for Bailey, and Christine Lagarde in for attendance, Georgieva to join us later. All of these elites are saying one thing: say as little as possible. And that's really what I think.
Well, let's go through it, Tom, piece by piece, and what we've got lined up for throughout this morning. It's not just about Chairman Powell. It's not just about the Federal Reserve. Arguably, if you strip the United States out of the equation,
I strongly
the
agree.
rest of the world right now is in a very, very different predicament. Slowdown in Europe, slowdown in China. They're struggling to respond to it. In the United States, we're talking about resilience and potentially 3% GDP growth this quarter. Germany right now, Tom, would kill for that.
This morning, the
Without
news out of Germany was stunning. I'm going to open my conversation with Lagarde on a speech she gave in April. The world has been turned upside down since April, and this is a different Jackson Hole, Lisa, than I think we saw 6 weeks ago.
I think it's notable that we're here with the backdrop of classic American Western glore, and it's such an international confab with people traveling 30, 35 hours to get here from all over the world to come together. And there's a question here: who affects policy more, the central bank in the country or outside of the country? Does Bank of Japan have more effect on longer-term yields right now in the U.S. than Chair Powell? These are some of the questions at a time where this is a very global economy that is splintering.
In full disclosure, folks, within the wonderful tone here of the Kansas City Fed, I've seen more of the chairman of the Federal Reserve Bank of the United States of America in the last day and a half than any other chairman I've ever seen there. They're usually closeted away. Bernanke's up top. This time of year, Bernanke's up top watching the Red Sox. Okay, Powell has been very visible.
Is it fair to say he's more visible this time around compared to 12 months ago because he's in a much better position, Tom? It's so much better for him this time around.
And to your point, and you've been an arch critic. I mean, Ferro to get him through customs here at Jackson Hole was something with the Fed. But the truth is, you've been a critic, as others, of the mistake of transitory. And there's a couple good charts. Krugman had a great chart about, they sort of jump skipped. It was ugly, but sort of like transitory is here.
Well, what's the risk now?
I can't do a thing with my hair this morning.
We can sort that out for you. We can sort that out for you. What's the biggest risk now? The risk now for some economists, including Neil Datta of Renmark, others too. I'm going to mention Neil all morning. You know I am.
Yes, of course.
Neil's thinking about the potential for a re-acceleration in the economy, Tom, and maybe reigniting the risk around inflation again. Is that the risk we face this time around?
That's maybe a short-term risk, a traditional worry about inflation. That my major risk is the underestimation of coming out of a major health pandemic. All of our guests today can address where we are in the long COVID theme. They're all writing about it, whether it's China. Adam Posen will be with us in moments. Brilliant on China in the last number of weeks. This pandemic, we still have unmeasured.
The question about the risk, the balance of risks, if you're patient, which we expect to hear from Fed Chair Jay Powell, is there a risk that you get behind? How big is that risk? Do they have the confidence that they can get ahead of it after the fact, even if it becomes entrenched? Are they going to move away from this idea that people actually are going to have inflated inflation expectations?
We're 5 minutes in. It's time for some snark. Define patience. What, 20 years?
But
Wait for this mortgage market to
okay.
sort itself out? One conversation we can have, if you want to be critical of this Federal Reserve, how screwed up is this mortgage market now in the United States? And for how long, Tom? Is this a generational story?
Yesterday.
Yeah, good luck with that.
There's no
That's
problem
his own
with the
story.
American
That's his own story.
That's
a Tom Keene problem.
I looked at 1,600 square feet in Jackson yesterday,
100%.
4 bedrooms. It's got the cow motif and the elk motif. Elk above the door, $2.45 million, and there's no garage.
Just for the record, Tom, I don't think that's a decent example of the rest of this country. Jackson Hole? Probably not. Let's check out the price action just briefly. On equities right now, we are positive on the S&P 500 by something like 1/3 of 1%. Yesterday was fascinating to see NVIDIA knock it out the park the way they did, and then see the NASDAQ Gramo off the back of it. It's just absolutely fascinating. This market a whole lot weaker in the last 24 hours.
We had a 107 on Eurodollar. I noticed that. I thought of you, John.
Thank you, Tom.
There's a little bear ground outside the door. I was awake at 2 a.m. And, I see a 107 on Euro, and you predicted
This is very emotional. I think it's probably time to get to Adam Posen, TK.
I think we should go. Let's do this right now. We start strong here at Jackson Hole. We always do that at Jackson Hole. And we do with the gentleman who set the landscape for China in the last 6 weeks. His article in Foreign Affairs magazine, definitive, but far more than that. Adam Posen is a student of the Federal Reserve System at the Peterson Institute, truly one of America's experts on Germany. That's a good place to start, John.
Fantastic. Adam, great to see you.
Thanks
Good morning.
for having me.
12 months on. It's so different. Can you frame for us the difference in the backdrop for Chairman Powell 12 months ago compared to where we are now?
Like you said, last year was 8 minutes. This year's going to be 20 minutes. Like you said, last year was a rifle shot, or I've said that, totally focused on getting the pain. This year is going to be totally focused on fuzzing things up. That we're committed, but doesn't mean we're going to drive the economy into recession. I think Powell will be prudent, best of both Greenspan and Volcker, not claim victory. But yeah, it's a different world.
Sarah House of Wells Fargo a number of months ago came on this program with us, and she talked about the last mile, getting inflation down from the 3s down towards 2. I think you've alluded to it just then. Is the juice worth the squeeze? Is it worth killing the labour market to get that extra 100 basis points of inflation lower?
I and a lot of people would agree it's not. The question is, how do you manage that from a communications perspective? And this is why my colleague Jason Furman is out there, and I'm out there, and others, Olivier Blanchard, are out there talking about potentially raising the inflation target. People say you can't raise it now, but my worry is the opposite, which is you say 2 means 2, but it's going to be another 2 years before we get to 2, and yodi-do. And so I'm wondering if you have a bit of a tension there.
I'm surprised here with John Williams walking by me, I think it was yesterday, the lack of an R-Star debate at Jackson Hole. Your shop, Peterson Institute, has provided real leadership on this through the studies of Olivier Blanchard. Give us an update where Jerome Powell's R-Star should be.
Well, first, he should be substituting the 10-year bond rate for R-Star. I mean, if you go back to Powell's first Jackson Hole speech as chair a few years ago, you'll remember he said, enough with this unobservable star stuff, unobservable R-Star, unobservable U-Star. And I think that's right. These estimates that come out of Laubach-Williams are completely non-robust, don't update meaningfully in real time. They swing hugely.
Starting harsh in the sunrise.
Sorry.
Please.
It's Jackson Hole. It's time to get busy.
That's going to be our promo for the next 3 years. Carry on.
Excellent. But look, I think what we had, and you may recall, I hosted for Peterson a debate between Blanchard and Summers about 6 months back. And then the IMF has their views. Basically, there are a lot of fundamentals that say rates, long rates, which are the proxy for R-Star in the real world, should be down back to where they were pre-COVID. And then there's a bunch of arguments saying we're going to have fiscal boom indefinitely, defense spending, green spending, CHIPS Act, industrial policy, and a little bit of inflation premium. R-Star should be up.
Well, this to me is a crucial debate because it also raises a question about rate cuts next year.
Right.
If they think that R-Star is naturally lower, then the rate will be naturally restrictive, more restrictive, and will cause them to cut. Based on your conversations, there's already been a dinner, there have been lots of sightings. Based on your conversations, where are most Fed members right now?
I think the most Fed members are going to be like they were on inflation, a couple of years ago, which is willing to be behind rather than make a big mistake by preempting on the basis of dubious forecasts. In other words, they're going to wait. They're not going to say, I know that real rates are going up because inflation's going down, because some of that's already priced in.
Do you think that's a policy mistake because it loses credibility for the Fed, especially if they don't explicitly state that they are going to allow inflation to be higher?
I think it's a risk. I think it's night and day versus a year ago, Lisa. I don't think the credibility risk is anything like what we were talking about a year or 2 years ago. But I agree. I think that's a risk. If you say one thing and do something else, it's always a risk.
The heritage at the Peterson Institute, the leadership of Nick Lardy in talking about China, you carry it forward with a brilliant essay in Foreign Affairs on what do we do next about China? What should be the Biden administration's 2024 path in this fractured relationship with China?
Well, first, let me say thank you for citing my colleague as well as my own article. And Nick has a blog where he fundamentally disagrees with me. And
that's the heritage.
Right.
That's the heritage of Peterson.
Right. We debate. And so just recommending people read my article, read that. In terms of going forward.
I like that, Adam.
No, it's true.
That's good.
Appreciate it. But look, I think going forward, as I put in Foreign Affairs, Biden administration has to be thinking more in terms of suction than sanctions. That because China's problems are real, because I think they did have a turning point with the zero COVID policy in Xi, that there's going to be more people, more money, more capital, more ideas looking to exit. And rather than us deterring China and trying to contain them, what we want to do is put pressure on the regime so that Xi, if he gets paranoid, which he seems to be doing, or gets into self-sustaining, puts up more barriers. And we've seen this movie before. The more barriers he puts up, the more people want to get out. I don't mean literally millions of people, but just the pressure outward.
We can squeeze this in, Adam. I think it's important. We've always given the policymaker there the benefit of doubt. There seems to be the consensus view in markets amongst market participants. There is this question just bugging people. Is it different this time?
Yeah.
Is it different this time?
On the plane over here, John, I reread parts of Ez Vogel's Deng biography, and it goes back to there was this multi-year battle between Deng Xiaoping and Chen Yun about too much austerity, too much growth. And I think we're back to that, except Xi isn't willing to listen to others the way Deng was.
I don't care. Red Sox 17, Houston 1. Are you going to walk down Beacon Street, across that magical bridge, just on the other side of Kenmore Square, to playoffs and World Series with the Red Sox this year?
I'm going to walk to my refrigerator and get snacks and watch it.
There we go.
Adam Posen at the Peterson Institute. Adam, thank you.
Thanks for having me.
You had to squeeze some baseball in there. Was that for the Yankees fans?
No, this is right. With the new playoff structure, John, this has changed. Yeah. It's like Premier League, but they changed the rules. With the new playoff structure, the new middle of September is right now, the end of August. It's mental.
You feeling better about this year?
I'm feeling better.
Okay, feeling good.
I thought that you were going to talk about Adam Posen's change in garb. I mean, he's like completely transformed man. No shorts, no short sleeve shirt. He's got a jacket on, and he came to set looking cold.
What's great here, folks, I really can't say enough about our team that set us up this morning. Just now, the glow of the sunrise above Bramo.
Which I don't think you can see.
You can't see it yet, but if you had the Bramo cam, it's just behind the Bramo cam. You can see the first light of Jackson Hole.
It's a very impressive green screen, isn't it?
It is, yeah.
It's tremendous.
It's good. We're going down to Starbucks on 3rd Avenue after this, right?
It is beautiful. I believe sunrise in the next 15 minutes or so, TK. That backdrop's going to look a whole lot better in the next 15 minutes or so. Coming up next on this program, do not miss this, the IMF Managing Director, live from Jackson Hole. Good morning.
While higher interest rates, slower growth, and softer labor market conditions will bring down inflation, they will also bring some pain to households and businesses. These are the unfortunate costs of reducing inflation. But a failure to restore price stability would mean far greater pain.
That was Chairman Powell in Jackson Hole, Wyoming, just 12 months ago, and what a difference 12 months has made. We thought a year ago to get inflation lower, it would mean the pain that Chairman Powell promised. TK, a year later, and here we are with unemployment almost exactly where it was back then.
Let us remember, and you can go right here to Wyoming and the high prices and the working people of Wyoming. A lot of America doesn't feel that disinflation. This is an academic exercise wrapped around a huge body of Americans, John, that are like, I don't care if it's 3% or 5%. This is miserable paycheck to paycheck.
And it could get a whole lot more miserable. But at the moment, Tom, if you look at the aggregate numbers, the headline figures, we're talking about potentially resilience. Lisa, I don't even think resilience as a word captures where the US economy is, just in terms of how the data's come through. It's been so much stronger relative to what we've seen in China, relative to what we've seen in Europe, and continues to be so.
And everyone keeps waiting for it to diminish. Everyone keeps thinking it will eventually stop. And then yesterday, the jobless claims came out lower than expected. The labor market not showing the cracks that people were expecting. And then people freaked out. I think that that's fair to say. You saw a complete reversal. It just took one thing to say, nope, it's still not cracking. And that really raised some questions.
There's been one change in the last week. The retailers.
Yeah.
You just go through them one by one. Theft at Dick's Sporting Goods, flagging the repayments for student loans later this quarter, later this year from Target, from Walmart. Take your pick. I think it was Dollar General yesterday. Dollar General, Tom, talking about pain for the US consumer. The retail earnings we've had in the last week across a select few companies, TK, speaks to the pain that you're talking about in the US consumer that perhaps isn't captured in the overall headline numbers.
The single best chart on this, Liz Ann Saunders and her team yesterday at Charles Schwab showed the equal weight market versus the tech weight and all that, where we've really hit a tip point in the last 48 hours with that retail debacle. What we're going to do at Jackson Hole right now as we begin in the sunrise of this important Friday is take a more international perspective. She is not here at Jackson Hole, but in heart and soul, her institution, the International Monetary Fund, decisively is. Kristalina Georgieva joins us, the managing director of the IMF, off a recent essay on what everyone's talking about, the fragmentation, the fracture of the global economy. Dr. Georgieva, congratulations on the essay that you and your team put together for Foreign Affairs. You speak of fragmentation. How urgent is the need for solution right now? What needs to be done now to begin to a more stable global economy?
It is urgent, and that sense of urgency is lacking, Tom. Why is it urgent? Because we have moved in a more shock-prone world, in a world of more uncertainty. And in this world, we need each other even more than before, and yet cooperation is in a retreat. What does that mean? It means that unless we wake up and we act pragmatically in the areas where we can find common ground, and in the areas where we must find common ground, like the fight against climate change, we will drift into a world that is poorer and less secure. We have run the numbers. Unless we wake up and we pursue this pragmatic collaboration, we are going to be losing about 7% of global GDP in the long run. I mean, that is like wiping out France and Germany from the economic map of the world.
Because of time, Dr. Georgieva, it's so important. I get this in this morning. I want you to speak right now to the four major central bankers assembled here in Jackson Hole. The singular call this year is the 5-year caution of economic growth of your institution. You call it slowbalization. How do those four central bankers assembled here get us out of slowbalization?
It is not going to be only the job of central bankers, but yes, they play a role. And their role is to be very careful in assessing how data informs their actions. We are going to see, Tom, after a period of convergence in monetary policy action, tightening rates, fighting inflation, some divergence, because where the U.S. economy is very resilient, I was listening to this discussion just before me, the European economy is not. There is less strength in the performance over there. So central bankers will have to recognize that some specificity in how they approach the fight against inflation and how they link this to their role in supporting growth and employment, how they approach that is going to be a matter of thorough assessment, of national data. Let me just make one point about the United States. What we see in the US is very strong demand for services. Very good, but not good enough for the world economy because it doesn't translate into spillover for global growth. Right. And this is why my main point is there would be some divergence in policy approaches across central banks.
Kristalina, is fragmentation inflationary?
Of course it is. Why? Because...
How much so? How much should that be considered?
If you take the main impact of fragmentation through trade, what it translates into is pushing cost of production up on a global scale. How inflationary it could be depends, of course, on how that specifically reflects into cost structures across national economies in the world economy. But the pressure on costs and then through that on standard of living of ordinary people certainly comes when we fragment the world economy.
Kristalina, I just want to squeeze this in. I've got about 60 seconds, 90 seconds left on the clock. You've said the IMF needs more resources. Can you be a lot more specific about what that means? What do you need and where do you expect those resources to come from?
Well, let's face reality. More shock-prone world means countries need to have more capacity to face these shocks. Today, global reserves are concentrated in a small number of strong, advanced and emerging market economies. 10 countries hold 2/3 of global reserves, and all the small, medium-sized countries hold less than 1% of global reserves. This is where the IMF comes in. We are the insurer for the uninsured. Today, our size, $1 trillion lending capacity, is just not enough to be the buffer against future shocks that we all anticipate are going to be happening. And also what we want to see is reliance on own resources. We are discussing with our membership to bring the quota resources of the fund again above 50% of our funding level. Today they are at 40%. So we are talking about a not a minor increase, but I think everybody understands that this is a provision of a global public good. If the IMF cannot hold financial stability in vulnerable countries, that is hurting not only those countries, it has negative spillover for the world economy. So
Kristalina, thanks for joining us today.
About a couple of $100 billion that we want to see being lifted up in our lending capacity.
Well, that was the punchline I was looking for. The IMF Managing Director. Kristalina, thank you. It's good to hear from you. Thank you. Thank you very much. Tom, I would argue perhaps an institution struggling for relevance in a fragmenting world. That's the brutal assessment of what they face at the moment.
I strongly support that idea. They are struggling for relevance away from the distractions of Argentina. In her essay, she talks about the train wreck of Zambia. They've got these major, major headaches wrapped around what the four major central banks do.
Chairman Powell, just around the corner, 10:05 Eastern Time. The preview up next with Neela Richardson of ADP. Attempting to get you towards the weekend. Let's check out the price action on the S&P 500. Equity futures here elevated by 1/3% on the S&P. The Nasdaq trying to bounce back up 1/4%. Yesterday, I think brutal. And I'm going to say it's brutal, not just because of the move, but the move relative to the news. The news was good. Nvidia knocked it out of the park, Bramo. It's what we wanted to see. And the Nasdaq faded and faded fast.
And the fact that it was up, the Nvidia in particular, was up almost 7%. And then all of that almost retraced. And everything else just sunk down. Sell the news, right? I mean, that basically is what everybody was saying.
It's an interesting time, but it's also August, and we're addicted to up, up, up. I mean, the pullback, have we had a correction yet? I mean, it's great.
What are you looking for, 10%?
It's terrible, but to your point earlier on retail, this is always true of a correction. There are selected sectors that are absolutely hammered And that's what we're seeing.
What surprised this year, the US economy? What underpinned that? Consumer spending, discretionary spending to be specific, airlines, beyond the airlines, cruise operators. Is that going to start to fade into year-end, Tom? That's a big question. The retailers alluding to that over the last week, flagging that they think there's a potential for that to happen. The problem is, Lisa and I talked about this last week, Tom. It's the economist who cried recession 20 different times over the last 12 months. You've got the retailers flagging weakness again. And I think a lot of people are shrugging their shoulders and just thinking, well, I've been burnt by that view a million times over.
I'm not going to mince words about this. The people, the fancy people that wear Montclair ski jackets, it's just as simple as this. They haven't been touched.
Do you guys want to stay sitting next to each other for the whole time? Seriously?
I don't know, we're 30 minutes into the program.
He's already trying to tweak you.
There's a part of America that has not been touched by this recession. Right now in Jackson Hole, Wyoming, 2/3 of America says, you guys are nuts. We're in a recession. That's about it.
Do you want the feedback this morning? Great reporting, beautiful sunrise. Old school locals used to criticise the tourist newbies that incorrectly added the hole to the official name of Jackson, Wyoming. That's the feedback this morning, Tom. Is that helpful for you? The ski bums.
I've been here like 17 years. I'm going to Jackson tonight for the first time.
Can I tell you?
I'm going to some steakhouse and have fish. It's going to be great.
Nice.
People call it J-hole, who are, talking about it in other places, which is just dreadful. But, just to give you a sense of just how wrong we are.
Very wrong, apparently.
Very wrong.
Turn to the bond market just briefly. Two-year yield still in at around 5% at the moment. That drift higher in yields over the last month has been pretty impressive. 422.95. I think in the past week,
on a 2-year?
cycle high was about 436 on a 10-year, Tom. So we've come back from those levels, but that was a shocker for many. A shocker for many.
Did you see the 3-month T-bill yesterday? It was like, wow. I mean, these are some serious surging rates. Lisa, under surveillance this morning, it's our weather report from Jackson Hole. John, 48. Last year at this time, it was 42.
And raining.
And the 6-degree difference is like, this is like balmy.
It makes a difference.
It makes a huge difference on a perfect day.
I thought you were going to say something about the bond market, but maybe not.
No, I'm doing the weather report. That's what we're doing now for under surveillance.
From the weather to foreign exchange, let's squeeze in the euro and do something sensible.
It's natural segue.
OK, you said we saw 107.
Yeah.
We're back to about 108.11, Tom, on the euro.
Swissy did not confirm the gloom in euro. Seriously, Swissy did not go stronger on this recent move in euro.
In Germany, the data, Tom, less than impressive. President Lagarde, you catch up with President Lagarde a little bit later. Run us through it. This is a tough spot for her.
The list of things I can't talk to her about. You can't talk about Germany, Tom. We'll see how that goes.
Don't talk about rate increases.
This morning.
Don't talk about policy.
What we're going to do right now is talk about the most important person in the lodge here at Jackson Hole. It's a bunch of fancy academics writing fancy papers. What they want to know is, what do the paychecks of America look like? With that leadership is Neela Richardson, chief economist at Automatic Data Processing. She, more than anybody else here, has an understanding of the American payroll, the American labor economy. With Parchment from the University of James Bullard of Pennsylvania, Maryland. Thank you so much for joining us. What does ADP say right now? What does the payroll of America look like right now?
It's solid, but it's fragmented. And we've seen notable declines in wage growth. After last year, wage growth moving sideways, we're actually seeing some traction downward. So that's good news to amplify the Fed's already good news going into this Jackson Hole meeting. And by the way, wow, what a view. You guys really...
Do you like that?
It's beautiful.
Matt Timmons did that. He moved the mountains 6 feet this way just to get the shot right this morning. I want to talk to you seriously about the dynamics of wages and inflation, the real yield. There's an optimist view that, yeah, the real yield's there, but wages will stay strong. Do you agree with that? Or do wages come in even while the real yield goes up? That's not good for America.
That's the open question. There's a sense that where we've seen the highest wage growth has been for low-skilled workers with low pay. Now, let's be clear. Even though we've seen double-digit wage growth for almost an entire year, that translates to less than $5,000 in your average paycheck in low-skill industries. So it sounds like big double-digit numbers we should be concerned about when we look at pay growth. But for the person on Main Street, it doesn't really fill the gas tank and buy the eggs and pay for education and healthcare in the same way.
Let's carry on this conversation. I think this is so important. Why are people in this building in front of us, when they get together every year, concerned about pay growth, when everyone else away from all of this loves a pay rise? What's that about?
Well, wages are the bridge between the labor market and the inflation, right? And so you want to make sure that that bridge is going towards lower inflation, not higher inflation. And in that sense, it matters for Main Street, too, because you want real wages to grow. You don't want nominal wages to grow. And what we've seen is a lot of nominal wage growth because of high inflation. Now, that's shifting as inflation goes down. The question is, will the persistence and strength of wage growth built by an undercurrent of productivity continue? Or was this all just churn and competition prompted by inflation? And I think that's the critical question for me in these many years.
Big pay deal from UPS, big pay deal for American Airlines pilots. A lot of people are going to see those headlines, go to year end, sit down with their manager and say, I want some of that. Why don't you think that's going to happen?
Negotiation at the end of the year is always pretty tricky. And one of the biggest questions we've heard from employers is, how do you negotiate a salary in an inflationary environment, right? Because you can't have a sense of what's next year's going to look like when inflation's all over the place. And now we've seen that trajectory go down. The balance of power has shifted back again to the employer. So what's on the table in terms of negotiation? It's remote work, it's benefits, it's wages, it's this whole package of things. And yes, there are some pockets and some occupations that can win the wage negotiation argument. A lot of other people are just going to see smaller bonuses this year.
Let's underscore this, especially because we do get the United Auto Workers vote at 11 a.m. Eastern today, and that could potentially have material impact on Detroit and all the auto manufacturers there. Are you saying that when we say the power is shifted to labor, that's overstating the fact, and that's not the reality? It's just a small pocket here and there, and the rest of them, it's the employer saying, get back to work, and you're not going to get that big of a pay rise.
The fallacy of the labor market, as it's discussed, is it's talked about like a monolith, when it's really just an aggregation of microcosms. And some are strong and some are weak. And so when you have a union negotiating a wage in a market,
4-syllable words.
And it's early,
No
and there's not enough
words.
coffee in this world for that.
Here, have some tang. Would you like some tang?
And you had a late night with Jay Powell. Carry on.
When you have a supply-constrained market, a collective organization bargaining structure, and the need to increase pay, that's like a perfect storm, right? But that's not the whole market. And so you're going to see different opportunities for wage growth in different microcosms of this market, and we can't talk about it as one broad stroke.
I was making a joke earlier, but it's not funny. The people here really listen to you in market economics and payroll economics. I want you to speak to 4 central banks right now. Are we beyond where we can aggregate any nation, any central bank, any America into one set of economic analysis, or are we out front of John Edwards where it's 2 Americas, 3 Americas, or the 28 Americas that ADP looks at?
Why I love this question.
Are you okay?
Yeah, you did great.
Okay, thank you.
Why I love this question and why I love the theme of this year's conference, structural constraints or structural shifts in the global economy, is that it's a recognition that the inflation story has been mutated by the pandemic. And the trajectory we were on globally in terms of inflation has been permanently shifted. And that means that we can't just be cyclical. We have to be structural on the drivers of inflation over the long term. And the sense that once we get through this episode, we start cutting rates and things go back to normal, I think that's a little optimistic. That misses the whole point that inflation could rise again next year or 2 years from now or 3, that it's not going back to a 40-year slumber. And that's the important point.
Some people are talking about the long and variable lags. We laugh often. How long, how variable? What are you talking about? Within the labor market, how much have rate hikes actually diminished some of the power that you've seen in hiring and the ability to get jobs?
You know, it's been shifting. So we're still at record lows in unemployment. And what we've had is when one door closes, like large firms in tech hiring, another door opens, like small firms. In fact, over the summer, 60% of the new jobs added were from small firms with under 50 employees. These were the tigers of the labor market. Very different this year than last year. We also saw the hiring be very different in the motivation. So last year, it was a lot of replacement hiring. Now you're seeing firms actually add to headcount. So yeah, the numbers are going to be smaller, but they're going to be more real and more persistent and more sustainable. It's not just replacement.
Let's not do forecasts. Let's do best guesses.
So I
12
love
months
best
ago,
guesses.
best guesses,
which is another way of saying forecast.
We're being kind. Best guesses. 12 months ago.
It's forecasts you don't back test later. So.
Exactly. We're being kind about this. 12 months ago, unemployment around 3.5%. 12 months later, unemployment around 3.5%.
Yeah.
When we do this again together next year, where do you imagine, best guess, unemployment's going to be?
I think it's going to be around 4%.
Which is pretty marginal.
It's pretty marginal.
Is that consistent with getting inflation back towards 2% in your mind?
This is what I'm talking about, of the mutation in the inflation trajectory, because those labor shortages are persistent. They're not going away. If you look at the demographic trends of the United States and in advanced economies in Europe, you see an aging population, a population that is non-working growing faster than the population that is working. That means there are fewer people producing the stuff that the population needs, and that is inflationary.
The heart of the matter, and you did this at Maryland with their great public policy program, the bottom line is the middle of America is being carved out. ADP sees this in micro data to 4 decimal points as well. What's the public policy prescription for the next president of the United States and, frankly, the next chairman of the Fed to help the middle of America that's being carved out?
You're giving me 30 seconds for this answer?
No, 28 to go. We'll extend it.
You can have a couple of minutes for this one.
I think it starts with skills and job growth, because one thing I haven't heard yet, though I expect to hear today, is this innovation boom that is at the precipice of changing how all of us work. And the question for middle America is, can they evolve with the change in technology? Right now, it's a choice. That technology could make middle America more productive, which is when wages grow for the right reasons, and no one argues with wage growth based on productivity. That's higher profitability, that's higher standard of living, and it's disinflationary. What people do argue with is when it's displacing labor. And right now, the verdict is still out. I think the hope and the energy is around making workers more productive, and that could be helpful.
You sat next to Jay Powell last night at the dinner. So what did he tell you he was going to do? What's he thinking?
I think it was some guitar playing in his future, maybe some golfing.
Okay.
Hopefully some visits with his family.
Oh, nice.
So
didn't talk about September 20th, big event.
He's retired. Is that what you're saying?
Yeah, I think that those long-term plans. Remember, we're talking about the long-term
the long and variable lags in his work schedule,
not the short-term immediate future.
No, the long and variable lag for Jerome Powell is a distance to the next Dead concert.
He loves that, doesn't he?
He loves that. Yeah, he's like massive. Yeah.
Yeah. Nina, this was fun. We've got to do this again. Do it again soon. We won't wait until next year. Don't worry.
Backdrops like this.
Can we take a shot of this? It's just beautiful. It's just beautiful.
Beautiful.
It's stunning.
Yes, definitely.
What a great location, TK.
It is. I've been looking for bar this morning and an elk, and it's a little. We haven't really showed up yet.
You've been looking for a bar or an elk? I wasn't sure.
Bar.
Elk and a bar. I don't know.
Bar. They say bar out here. They don't say bear.
But they call bear what?
Bar.
What are you talking about?
Stop it. I think you had a few too many and someone started winding you up last night. That would be my best guess. Nina, thank you.
Nina
Richardson of ADP. Mike McKee coming up next.
I would say that we are in a position in Europe now where the Eurozone economy is basically stagnating. We are now certainly in the restricted territory, and we got into the restricted territory by rapidly hiking the rates so far. Whether we are in a restrictive enough territory remains to be seen. And this is something that we'll only see from the inflation data that will come in the next spring.
Boris Vucic there, the ECB Governing Council member and Croatian National Bank Central Bank Governor, came very, very close to saying the S word. Not stagnating, stagflation. In Europe, it is a very different backdrop to what we're experiencing here in the United States, where we're making progress on inflation but still witnessing a robust economy. In Europe, anything but. They have an inflation problem and parts of the economy, parts of the Eurozone, TK, in recession. Dare we use that word stagflation to describe what Europe is experiencing right now?
With a war in Ukraine, and I think you can say, I'm not knowledgeable enough to say you could say full European recession, but I don't care about any NBER stuff or other analysis. Boy, interview after interview, data after data, it's recession.
Where's the growth going to come from? I mean, if Germany is really the one that's leading the recession, and it really is driven in part by what's going on in China, and their economy has not been as disconnected from China in any way, shape, or form, the same way that the U.S. has.
$16,000 business class plane tickets to Paris. That's what's going to save them from recession. That's how silly this is.
With what airline?
Well, it depends.
United? I mean, yeah, that's right. It's based in the U.S. Carry on.
But the bottom line here is what's saving them is this hope and prayer of an elite. I'm going to associate it with Mr. Macron of France, which is probably unfair. But there's a whole other Europe out there that's flat on its back. There's no other way to put it.
Big time. Let's whip through the price action just to get you all up to speed and prepared for the day ahead. Equity futures on the S&P 500, slightly positive, up by 0.4%. In the bond market, the 10-year cycle highs in the last week or so. Back to way since then, 423.54 on a US 10-year. Going into Chairman Powell at 10:05 Eastern time, looking for a speech maybe a little bit longer than the speech from 12 months ago. But I just want to sit on this just for a moment. The numbers we had from NVIDIA in the last 48 hours supported this equity market rally on the tech side of things in a major way, and this equity market faded. Mike Wilson of Morgan Stanley, Lisa, saying to Bloomberg Radio that this is a sign that this rally is exhausted. We know Mike's view coming into the year. We know how difficult it has been. But I think many people might find it difficult to disagree with that after the last 24 hours we've seen.
Michael Hartnett of Bank of America coming out and saying it just shows how much these tech stocks are interest rate sensitive, that there is this concern that if rates go higher, they are not going to be immune, and you are going to see a valuation reset, which is the reason why you have sell the news, even though the news was incredible. I mean, the amount of beat was really out of the water. I mean, this is another one. Exactly.
They did it in May. They did it again in August. That stock's slightly negative in the pre-market this morning. TK equity futures slightly positive. Up 0.5%.
Real 101 to the optimist is the VIX is under 17. And I know there's a lot of different Dean Kernot-like noise and all that in the VIX, but I just, we're not even back to a correction. Although, as we said before numerous times, so many people are looking at retail. I'm in shock over, say, what Nike's done for a number of days. I need a wide shot here. This is very important, folks. I just want you to understand that this morning on Bloomberg Surveillance Worldwide, as John brings in our leadership here, an umpteen years at Jackson Hole, we're cowboy hat free this morning. This was an executive.
I'm not sure why.
Executive decision. This is Bramo's decision, and we decided this early in the morning, cowboy hat free.
This is the first time I've seen Mike McKee. Because he's a superstar walking around.
Oh, yes. Like
walking around the lodge. Oh, yeah, just ignores me.
Yeah.
Walks straight past us. So, Mike, it's good to see you.
Yeah, it's nice to see you too, John, and I'm glad I had a few minutes for you.
Chairman Powell, a little bit later, you're going to give us the official preview. How different is this address going to be compared to the address that we got 12 months ago?
Well, it's probably going to be about 10 or 15 minutes longer, for one thing. I don't think he has the same urgency in sending a message. Last year, the markets and the Fed were wide apart, and he wanted to bring it back closer together. This year, the markets are doing what the Fed wants. I mean, yields are up, and that helps make policy more restrictive for right now. We don't know where they're going to be September 20th, and he's going to probably say, we're going to wait till September 20th, or at least till the next jobs report and the CPI and the PCE inflation numbers, and see if they feel like they need to move again. And the bet is they won't. But he's going to leave his options open.
There's images on Instagram, folks. You can see this of Mike McKee leading what he calls a perp walk as the central bankers walk down here in a number of hours to gaze out at the vista behind us. Ueda, Lagarde, Powell, Bailey, not here this year. Are they unified? Is there any kind of a unified message of these central bankers, or is it, as Bremer would say, every central banker for themselves?
No, I think strategically they're all unified because they all have the inflation issue they have to deal with, and certainly the UK and the Eurozone have the same sort of inflation problem as the U.S. It's too high. The Japanese, it's too low. But the message from all four of them, when you throw Ben Broadbent in, who's going to speak tomorrow, is basically going to be stay the course. What we're doing now, we need to keep doing. We need to keep the pressure on inflation in those areas where it's too high. And in Japan, we need to keep inflation higher.
Yesterday, former St. Louis Fed President Jim Bullard was on Bloomberg Television with you, and he said this: I think the committee should take a little bit of a victory lap here. You were at the dinner last night. How much of a victory lap were people doing?
They're humble about it. Basically,
but they're still doing it?
Basically, they do still think that a soft landing is possible. They worry about the possibilities of some exogenous event, but they know that this, as somebody was calling in a research note I read last night, the last mile for inflation is going to be the most difficult. And so they know that it's still going to be a bit of a slog.
How much is the balance of risks clearly shifting among the majority of the members to killing off this proposition of a soft landing and not letting inflation get out of control?
I think that it's a dual message that we can achieve a soft landing. No Fed official or central banker is ever going to say, yeah, we're going to have a recession. And you were talking about Boris Vucic, and yesterday I also talked to Joachim Nagel, and they both said no recession, even though Nagel's economy is flat on his back. But they are going to say we can get a soft landing out of this, but we are going to do what we need to do even if we don't get a soft landing, because they need to keep the markets where they are.
There is a splintering on this committee. You've covered it really well for us over the last several months. We've heard it this week. The Boston Fed President, Susan Collins, speaking to the Financial Times in the last 24 hours, suggesting the resilience of this economy suggests to her that we might have to do more. Patrick Harker, who will be catching up with you a little bit later from the Philadelphia Fed, has spoken to various media outlets and suggested that he thinks we're done. Can you shed a light on that? Shine a light on just how much splintering there is at the moment on the committee?
These are tactical differences rather than strategic. Strategic, yes, we're going to raise rates, and we're going to keep them there for a long time. Tactically, do you go up by 25 basis points more, or have you done enough? That's the question that they're all debating at this point, but it's not really a huge division among them. And I think that basically the feeling on the committee is that the data will tell us what to do. If we see inflation start to rise, slam dunk, we're going to raise rates. Now, I don't mean just by a tenth or two that's base effects, but if we see some underlying inflation pressure, then we raise rates. If we don't, we can pause and wait for the next meeting, and all three of you will be debating that in November.
Back to Fed 101, as Chairman Powell speaks this morning, how much longer is his tenure? What is his timeline? This is not his last Jackson Hole, is it?
Oh, no. He was just reappointed last year, in 2001, by Joe Biden. So his tenure will end in 2025. And,
really, that far out?
Whichever president is elected in 2024 will get to name the next Fed chair, whether it's Powell for a third term or whether it's somebody new.
Well, based on the commentary we've had from the Republican Party, it won't be Chairman Powell. Does this institution have one eye on the politics developing in America?
One eye in the sense of what could it do to the economy, but they insist, and you read the transcripts of previous meetings, and there's always been these debates between Republicans and Democrats, and we've had government shutdowns, and they don't talk about it. They don't let it enter their considerations. They are sensitive to the public, but not to the body politic, as it were.
Have you got the check to write for McKee? That was longer than 2 minutes.
It is.
5 or 6 minutes.
Well, he's paid by the syllable, so, it works out.
Thank you, Mike.
I put it to a new hat.
McKee's got me going to the Gun Barrel Steakhouse tonight.
Is that what you're going
tonight? It's a
tonight?
Manly Steakhouse.
I can't imagine you in
I'm
there.
trying to get in. I mean, it's
He's wearing a bow tie to the local diner.
Yeah.
I don't know. It's iffy.
I'm pretty sure it's Western themed tonight. Do you have your Western gear?
No, I only have this.
I heard about that
Yes,
too.
and if you don't wear Western, you're in trouble.
Western Fridays.
Yep.
Big deal, TK.
Then I'm in trouble.
Coming up, John Lipsky, former first Deputy Managing Director at the International Monetary Fund from a beautiful Jackson Hole, Wyoming. Good morning.
heading into Jackson Hole, we're not expecting a major policy shift out of the Fed.
There's some anticipation that Powell will talk about maybe higher structural rates, higher R-star.
Jackson Hole is going to be an opportunity for Powell to flip the narrative a little bit.
I still think he's going to embrace that narrative of higher for longer, just given how resilient the incoming data has been.
I don't think we should be looking for any big surprises. You know, my sense is that Powell is going to get up there and he's going to reiterate exactly what he's been saying.
This is Bloomberg Surveillance, live from Jackson Hole with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
From a beautiful Jackson Hole, Wyoming, for our audience worldwide, good morning, good morning. The second hour of Bloomberg Surveillance starts right now on Bloomberg TV and Radio, together with Tom Keene and Lisa Abramowicz. I'm Jonathan Ferro. 12 months ago, looking out 1 year, this is not where we expected to be. This Federal Reserve has gone a whole lot further than we thought they would. This economy is a whole lot stronger. Tom, a lot of people got this wrong.
I'd take it from 12 months ago, they got it wrong, to even 4 months ago. The urgency of this Jackson Hole is something I don't think we even knew weeks ago. There's a tone here that I simply didn't predict, say, 2 months ago.
2 months ago, maybe a month ago.
Yeah,
this data, Lisa, has just been so much better. So at 10:05 Eastern Time, when Chairman Powell speaks, how different will this speech be to what we heard 12 months ago?
Last time he came around, it was all about pain, and how the pain on one hand of higher rates is better than the pain of having to struggle through inflation. And now we have inflation that's lower but still higher than it has been for years, not getting back to 2%, even by the Fed's own projection, until after 2025. Where's the pain? Is he going to talk about it, or is he going to reject pain and say, we don't need pain, we got it under control?
Well, we got it under control. I'm not sure how much control there is. They're going to do the walk this morning. McKee choreographs the walk where they go out and point at the mountains. I have no idea what they're pointing at, but Alan Meltzer climbed that high 20 years ago. But they're going to do the walk out. And to me, the question, John, you've mentioned this, the international tensions right now, the incredibly important paper by Barry Eichengreen to come tomorrow here. The international tensions here are underestimated by the American media.
Ex-US, strip out the United States. Parts of Europe in recession, really struggling to generate economic growth.
Yeah.
China struggling to respond to the slowdown they're experiencing at the moment. And yet you can still feel this slight excitement, just a little bit, about the prospect for a soft landing here in the United States of America.
No
and I cannot tell you, Tom, that makes people nervous.
No,
that makes people nervous that maybe they think the job is done. Now, what they're willing to say and what they think, there might be two different things, but you can sense it just in terms of the commentary we've had over the last few months.
Is that hope? You know, I do in all my reading, when I see the word hope, I circle it. Are we hoping for a soft landing, or is there any evidence of it? Yeah, they got a 5% American GDP. Let's pack it up and go home.
I will just say this. At 10 a.m., 5 minutes before Fed Chair Jay Powell takes the helm, we get University of Michigan sentiment survey, and we get inflation expectations over the next 5 to 10 years. I know how you feel about it, and I know how you feel about it. However, it does raise this question of the risks of waiting too long. What does that do to inflation expectations as people start to see year over year their costs just...
And there we go.
What was that?
Climb, go on.
Bramo dancing.
She was at the $1 million bar last night going...
All right, let's move on.
What we do, what's important here, I got an email. Do you bring... No, I got somebody, John, somebody emailed me. They said, do you bring the Bramo cam when you're on the road? Yeah, the Bramo cam's right over here, looking at the gloom. You know, we live stream it as well.
That's bonus content. That is too
John Lipsky's, you know, we got a wide shot. For those of you on radio right now, Dr. Lipsky's looking at us going, what did I get into this early in the morning?
Patience, John, please. Please. Let's get to the price action for you. We are about 26 minutes away from the opening bell in New York City, and this is how things are shaping up. Going into the opening bell on Wall Street, equity futures are positive by 0.4%. We really are trying to bounce back from the weakness in yesterday's session. The fate of today, arguably in the hands of one man, Chairman Powell, potentially. That seems to be the view. That address from Chairman Powell, exactly 1 hour and about 30 seconds away. Lisa, have we got a countdown clock for that?
Well, we should have a countdown clock.
Come on.
It's just like 1 hour.
We got a countdown clock for when the first elk comes out.
In the bond market, 424. Yields going absolutely nowhere. Cycle highs, new cycle highs. This bond market has impressed in a monster way. Think about where we were post-SVB. Post-SVB, back in spring, cycle over, hard landing, financial conditions are going to be too tight, banks are going to fail, and we'll be talking about rate cuts before you know it. It's the end of it. Literally the day before it failed, a 2-year yield at 5.08%, cycle high. All of a sudden, end of the summer, data's decent, and a 2-year yield, Tom, is just south of the cycle high we were at the day before SVB failed.
The nominal yields that the financial market keeps up with, but what I'm looking at is the real yield in the convexity, the acceleration that we've seen in the real yield is sobering. Right now, 1.91%, I believe it is, on the 10-year inflation-adjusted yield. Days ago, it was 2%. That's stunning to all of these economists assembled.
Would you like to frame our next guest?
Let me frame our next guest. This is a joy as well, providing international public service and joining the IMF a number of years ago. This is John Lipsky. Dr. Lipsky, of course, owns the high ground from Stanford Economics, his work at Salomon years ago, and we are thrilled that he traveled all the way from Europe to come here.
That's very kind of you, John. John, it's good to see you. Thanks for being with us. I know one thing that you're focused on, and many people are focused on it as well, also people at home, listening, watching, our audience, the changing relationship between this labour market and price pressure. What do you think we need to focus on right now?
Absolutely. The big question is, do wages follow inflation or do wages cause inflation? So far, the data suggests that wages follow inflation, not the other way around. And I think that reflects some big changes that have happened in the economy that haven't been clearly, some structural changes in the economy, international economy, that haven't been so clearly recognized. And that is the opening of markets in the 90s and the aughts and in the 2010s has turned many producers into price takers, from price makers. In the past, in the 70s, producers, especially in the U.S., were just willing to push costs along, pass them along to their consumers. As markets internationalized, that no longer worked, and they had to manage their production to markets, price takers. And as that has changed, the way wages have been settled as well. And so what we're going to find out is a test in this current environment. Is there any reason to expect wages to continue to cause inflation in the future? If not, then a soft landing near the Fed's target is a real possibility.
I don't want to bury us with a history lesson right now, but to have Eichengreen here and Lipsky and others, we celebrate the 50th anniversary of John Taylor's PhD at your Stanford. 40 years ago, this is at Alan Meltzer and Carl Bruner's Carnegie Rochester, much like Jackson Hole's summer conference. Taylor changed the world by beginning to talk about a rules-based architecture. Is that ancient history, or can we get back to central bank policy as people like John Taylor prescribed?
Well, there was just a very interesting conference at Stanford to honor that 50th anniversary of the Taylor Rule. And there's certainly a great interest, renewed interest, in central bankers going back to some kind of more clear rules-based approach to setting policy, not just setting a target, but explaining in a clear way what they would do to get to that target. Right now, we don't have that. And part of it is because, as we've seen, that our models about inflation, which is the target for central banks, hasn't been clearly established.
How much are central banks just basically cycling to keep up with fiscal policy and the fact that there's been so much debt and so much stimulus pumped into the economy, and they're trying to figure out new models for something that is modelless, that has no paradigm in previous history?
Well, that certainly has been a challenge, and it's one that looks like it's going to be there for a while, because a great move toward fiscal discipline doesn't seem to be in the cards right now. Anywhere in the world, we're going to have high fiscal debt for quite a while. But of course, part of the question is we've seen central banks also take different kinds of action with regards to public debt. QE in the U.S. and elsewhere now turned into QT as they work down their balance sheet. This is going to be a complex challenge, and there similarly is no model right now.
And that's where I wanted to go. This question of the Federal Reserve balance sheet. Yesterday, the total came out. It's down almost $1 trillion from the peak, just north of $8 trillion. We still have a long way to go. I'm just wondering how much that's contributing to a tightening in financial conditions. That's sort of the story right now, especially on the long end.
An excellent question for which we don't have a clear answer. What the Fed has decided is that if they go, let's call it a rules-based approach, and say the same amount every month or every quarter, that reduction in their balance sheet, that will keep markets calm because it's predictable. sounds like a rule. But in fact, we don't have a clear view about how this is all interacting. And as was going to be discussed here at Jackson Hole, how well the Treasury market actually works, the Treasury bond market actually works, has been changing and changing with rules and regulations have been introduced. And we'll be talking about, is there a way to make that market work more efficiently?
We're so honored at Bloomberg today to have you with us, with Christine Lagarde later on, and Dr. Georgieva with us earlier. And all of this is about fragmentation. You lived on airplanes for X number of years for the IMF, fighting against fragmentation. How close are we to the blocks, BLOC, the blocks that we studied as kids?
It's a wonderful and important question, and not easy to think through because of the following. We started in the post-war era with blocks, economic blocks, based on ideological and geopolitical oppositions. Markets started out fragmented. Post-1990, we entered the period of what I call true globalization that had profound effects on the world economy and enormously positive. Now, there's no instance of an emerging market economy that has sustained growth without being connected to global markets for goods, services, and capital. So the question is, they understand this. Is it possible that they will allow renewed geopolitical great power conflict to break up those markets that have brought, in essence, will they kill the goose that laid the golden egg?
So we need to finish where we started. With this fragmentation, do producers, to use your analogy, become price makers again?
That's a risk. That's a great risk. However, those who are leading or part of this renewed geopolitical tension also recognize that their economy depends very heavily on access to markets. This is how this will be resolved is one of the key questions of the coming decade.
John Lipsky, this was wonderful and deeply thoughtful. Thank you, sir. It's good to see you, as always. The former First Deputy Managing Director at the International Monetary Fund, Tom, with some strong stuff to think about with regards to a country I don't think we named, China.
No, we've underplayed China this morning with a focus here on the four major central banks. It's true, but the key word from Dr. Lipsky I heard there was complexity. These are not simple concepts. And in the American media particularly, and we're as guilty of this as anything, in the Bloomberg news team, polices us and tries to show us the complexities that are real right now. Post-pandemic, they're a new level.
I would take it a step further and just say that China's the elephant in the room here. And what they decide to do, and Xi Jinping's reluctance to really come in and support the economy in a material way. I mean, he came out with some half measures, or the Chinese authorities. Yet again, it lasted for about 10 minutes with a bit of enthusiasm this morning, and then everyone was like, you're not doing anything.
It's not getting it done, is it?
It's not getting it done. No. And at what point does he convince people that he wants to get it done when he doesn't seem to want to give what he calls welfare, and he doesn't want to necessarily connect to the international economy at the risk of risking national security?
This goes back to something John was talking about. There's a reluctance here, Tom, to adopt the Western model. A real reluctance.
Oh, absolutely. I mean, we want to get halfway back. I mean, some of the essays here on China say precisely that. It's where is the first initiative to get back to something that Deng discovered 3-4 decades ago.
The opening bell is just around the corner in New York City. We've said it a few times. The fate of this session in the hands of one man, Chairman Powell. That speech, 51 minutes away.
This reacceleration could put upward pressure on inflation, stem the disinflation that we're seeing, and instead delay plans for the Fed to change policy. There's some talk about base effects fading and going the other way during the second half of the year, so we'll see if that occurs.
The former St. Louis Fed President Jim Bullard weighing in on the global economy and Fed policy in the United States. I have to say, typically I'd say there are things you can say when you're an official at the Federal Reserve and things you can't say. and then when you're no longer a Fed official, you just sort of open up, you're unleashed.
It's like a changed man.
But with Jim Bullard, I don't think it makes a difference.
Come on,
I think Jim Bullard said what he thought when he was the president of the St. Louis Fed, and he says what he thinks now.
The great thing about Bullard right now is I think they did the shot from the football stadium at Purdue, and he's got the whole Purdue Boilermaker thing behind him, like he's rah-rah. But I'm going to give him at least till Purdue beats Michigan this year. I'll give him at least till then. I don't know when the game is ginormous, but, you know.
Well, I've promised people that I'm going to watch a college football game this year, so we'll make that happen. I want to check in on the price action for you. We are about 13 minutes or so away from the opening bell. Your equity market is shaping up as follows. Equity futures on the S&P 500, positive here by 0.3%. On the week, we are just about positive, but only just after yesterday's losses. In the bond market, we've backed away from those cycle highs on a 10-year yield of about 4.36. We're back down to about 4.24.53 going into that speech from Chairman Powell, Tom, in the next hour.
It is, and this is a wonderful moment now as we go to that speech with the central bankers gathered here on, yes, U.S. economics, but of course, international economics. And they will listen more to Barry Eichengreen of Berkeley than anyone here. He owns the high ground from Golden Fetters, his classic book on gold, until what we see with globalizing capital and now his intense focus on debt and the debt mess we're in. Dr. Eichengreen, thank you so much for joining us. How bad is the debt mess we're in?
Well, I think it's a big change from the pre-COVID days. Governments are going to be constrained if and when we have a global recession, if and when a bad thing happens. They have a lot less room to run fiscally because of the increase in public debts worldwide.
As usual, you've been out front on this, and the phrase that I hear from you is, and you say it with respect to the institutional pressures and our political leaders, the modern medicine that we have. What is the more stronger medicine we need to take to get control of our debt and our ratios?
I think we're going to have to learn to live with these high levels of public debt that the advice policymakers are getting from the Bank for International Settlements and the IMF about bringing down debt ratios. That's unrealistic. We're not going to be able to grow out of these higher debt ratios. We're not going to have a more favorable real interest rate going forward than we've had in the past. We're not going to be able to run primary budget surpluses for long periods of time. So I think we're going to have to tiptoe likely through this problem and manage these heavy debts.
Tiptoe, your words, manage. Other people might say this ends in disaster. Barry, what's the argument against that?
For countries like the United States, there is a big, remains a demand out there from foreign central banks and the international private sector for U.S. Treasury bonds. So I think the U.S. government is an exception to the general rule in that it has room to run. Other governments are going to have to reform fiscal institutions, worry about fiscal transparency, do all the things that the IMF and others have been recommending for years.
Does it basically suggest that longer-term yields in the U.S. are where they need to be? That basically the term premium is going to be significantly higher, that essentially what you see is what you get?
Well, I think the term premium can come down a bit, but not back down to pre-COVID levels. I think everybody understands that we're in a new world with higher interest rates. The question is how much higher, and I wouldn't be a pessimist about that.
How much has the debt that the U.S. has incurred in particular driven a lot of the inflation that we see? How much can we really basically write the book and say helicopter money actually does cause inflation?
Well, I think the fiscal stimulus that we in the United States did in 2021 was a contributing factor to the inflation, and there will be debate about that today because there were other contributing factors as well, the supply shocks, a variety of other things.
Take your study of debt, your view on the inflation-adjusted yield, which is maybe what the adults, the pros, look at, and bring it over to the Eichengreen application of monetary policy. And there's a whole R-star debate in that. Are we going to move away from a 2% regime? And how do we search out an anchored level that is higher?
Well, I think the Fed has to bring inflation down to 2% before it really opens that conversation. We saw in this recent episode the importance of credibility. and credibility and 2% are synonymous for the time being. The only time you talk about changing the regime is when you have everything under control.
Let's go down the hall at Berkeley to Brad DeLong's office. You and I are going to walk in with Professor DeLong, and I'm going to say to both of you, with your academics and his more political view, what's the price of bringing inflation down to 2%? What's the cost of that to Americans?
Well, so far the cost has been minimal compared to the doom and gloom scenarios we heard about unemployment going up to 5 or 6%. So far, so good.
But that's your hallmark. You have been the arch optimist against doom and gloom. And how do you respond to the doom and gloom that we hear daily from Lisa Abramowicz, or that we hear out in all of economics? How do you respond to that American gloom that you fought against for 50 years?
Well, look at what the Atlanta Fed Now Tracker is saying. The U.S. economy is on track. There's no sign of inflation on the horizon. Yet, in this kind of assembly of economists, there has to be one optimist.
Lisa, this is like the GOP debate, isn't it?
Yes.
Your name was referenced. Would you like to reply?
Well, I just wonder, at one point, is it unsustainable, this kind of enthusiasm, this kind of growth, right? I mean, at some point, you're not going to get down to 2%. I'm already changing it to 3%, 2% for quite a while, even by the Fed's own admission.
2025.
Exactly. After 2025. Right. Doesn't that reduce their credibility to some degree?
They have to have a credible strategy for getting to 2%. So this is the classic, give them a target 2% or give them a date, never give them both.
2%. Can we think about where it came from? Is this really about some people in New Zealand in the 1980s just coming up with a number? Is that what we're all doing here? 2%? What is it about 2%?
That's exactly what we're all doing here, but history has consequences.
Can I sneak in one? You're dead on. I mean, absolutely dead on. Absolutely dead on. The first time I think I met you, or it was like within the year I met you, some guy almost took a swing at you on a stage at Singapore at a G7 meeting. He was so angry with you. How do you respond to, OMG, the dollar's dead, renminbi ascended? Do you throw chalk at people at Berkeley when that comes up? How do you respond?
No, at Berkeley I don't hear it, but that kind of interchange, you get more invitations.
You get more speaking fees off that. Do you suggest the dollar is at risk given all these stresses?
I think the dollar is not at risk yet. So we in the United States can do things to damage its credibility, but nothing that happens at the BRICS summit this weekend will much affect the dollar.
You weren't invited, were you?
I would have chosen to come here anyway.
The word yet is so loaded. Barry, thank you. This was wonderful. Truly, thank you very much, sir. We are about 5 minutes out from the opening bell in New York City. This is what we're going to do. So at 10:05 Eastern Time, you'll have an address from Chairman Powell. We'll take that live and in full on Bloomberg TV and on Bloomberg Radio. Bloomberg's Mike McKee is going to react to that, and also Mohammed Al-Arian, just the perfect guest to spend a little bit of time with Tom off the back of that address from Chairman Powell.
Can I just say the team that's put this together, and McKee years ago, I mean...
Are you emotional?
McKee, I'm emotional
on the edge
now.
Of tears?
We have, not on the edge of tears, it's too cold. Lipsky, Eichengreen with us, Gorgieva before, Lagarde later, Dr. Al-Arian, and that. This is just so cool, and I didn't think it would be this cool even 5 weeks ago. That's how immediate this meeting has become.
On the edge of tears, 1 hour and 25 minutes into the program.
Well, I just saw the first elk out there. It's over at Bramo's shoulder.
Are you going hunting later?
No, they wouldn't let me do that.
DK hunting in a bow tie?
Keep it like, have a drink.
To a bear.
To a bear, exactly. That's
okay.
A bar.
Your opening bell is about 5 minutes away. From Jackson Hole, Wyoming, good morning. The week ain't over yet. The final trading day of the trading week. Your equity market on the S&P 500 positive. Futures up by a third of 1%. Up on a week, but only just. On the NASDAQ, up on the week and up again. Up by 0.2% and trying to bounce back from yesterday's losses. There's your opening bell. Switch on the board and get to the bond market. We look like this in treasuries right now. A 10-year yield, cycle high in the past week. 436, back to about 425. Yields nudging up just about a basis point, 35 minutes away from Chairman Powell. The dollar showing a touch of strength, the euro some weakness. Earlier on today, A breaker 108, a 107 handle, more weak data out of Europe, Germany specifically, through most of this week. That currency pair at the moment, 108, Tom, 05.
The correlations are, John, are germane, but I'm not seeing a breakdown like in strong Swiss franc. That really hasn't happened. The real yield hasn't popped through from the shock of 2% to a new level. But as I mentioned earlier, to me, the news yesterday, you take the 3-month T-bill, and I think you got to go back to Eisenhower's presidency over where it is. I'm kidding there, but you got to go. We're starting to go back on Eisenhower, John, president, just coming out of World War II.
Oh, thank you, Tom.
50s,
Thank you. Thank you.
But the idea here, we've lost scope and scale as if the people here of where these yields are back before 2007.
We'll do Churchill in the next hour. How about that? Does
Yeah,
that
I
work?
like
Yeah,
that.
okay, cool.
Yeah.
About a minute into the session,
Break out
your
the
equity
cigars.
market positive by 0.4%. Any excuse. On the Nasdaq right now, up by about 0.5%. Lisa trying to bounce back after a pretty dreadful day of losses off the back of Nvidia, when Nvidia looked pretty decent in yesterday's session for the best part of 5 minutes.
There seems to be a fear that people got overly complacent with the soft landing narrative. And to me, that has been the theme of this week, the slow transformation into Fed Chair Jay Powell. If he seems complacent, what that means for the long term. If he's not, and he pushes back with hawkish rhetoric, which some people think he will, in order to keep inflation under control, what that does to a market that is priced to perfection.
Or is it just simplicity in that if we do get disinflation, if it breaks down, and there's many people, David Rosenberg, Ed Hyman of Evercore ISI, if we get their outcome, do yields just naturally come down? Is that the massive bet that's really in doubt this late August?
I can't bet on what he's going to say at 10:05 Eastern Time. I'm on the same page of people who believe there is an incentive here to say nothing. I think he's highly incentivized not to say much at all. But again, Lisa, there has been this conversation about a higher R star, a higher neutral rate. I think when you talk to people around here, there's a reluctance to really subscribe to the idea that he's going to talk about that later on this morning. Why would he?
I can't imagine that he would. I mean, honestly, he's got no incentive to do so. So it's unclear whether this is going to be a market-moving kind of speech. What people are talking about is the tone, and whether he has a hawkish tone, a dovish tone. Does he talk about pain? Does he talk about soft landing? Does he talk about what he sees in terms of his future dinner plans?
Did you just say, is the chairman of the Central Bank of the United States going to talk about pain? Did you get that on the Brennan stand?
Okay. Well, but it's the tone. It's all about the tone. But to me, it's indicative of the importance of this meeting that the head of the South African Central Bank spent 30 hours getting here. Ueda, probably governor of the Bank of Japan, probably spent just as long, if not longer. They all came to this spot to look at these mountains, to talk about inflation, because they all are flummoxed. They don't know what to do right now, and I think that's important.
The confusion, and as Lipsky said, Dr. Lipsky, a former of the IMF, said, the complexity right now is over. It's different than 07, 08, 09. I remember the sweat then. It's different. This is not like Lehman, but it's just as complex as well.
At risk of sounding too much like you, TK.
We don't want that.
What does it come down to? Comes down to one thing, doesn't it? Comes down to the data. We've still got another CPI print. Let me get through it. Let me go through it. It's painful enough, all right?
This is really painful.
We've also got a payrolls report next week, next Friday. Okay.
Oh, next Friday. I'll be here.
September 13th. Good to know. September 13th, CPI. September 20th. September 20th, the Federal Reserve. We've still got to get through that to think about what they do in September and beyond. And if we still see GDP prints like the one we're like to get in the third quarter in early 2024, then the idea that this is done and dusted, I think you can park that idea pretty fast.
It's a 2-year, 3-year disease in the pandemic of asking too much of our central bankers. They're just going to look at the data. That's what they've done. Over the history of this event, back to Paul Volcker in the 80s. Do you know they got Volcker here just to do fly fishing?
I do understand that, yeah.
Yeah, I didn't know that.
It's the Kansas City Fed Symposium,
right? Yeah, and it was, somebody said, well, why is Kansas City in Wyoming? But that goes back to the huge history of these central banks.
Do you want to do that history now?
No, I don't want to do that history now. Stephen Whiting is going, yeah, I read that in my economics. Joining us now from New York here, an important conversation with the markets opening with Stephen Whiting, Chief Investment Strategist, Chief Economist of Citi Global Wealth. Stephen, I got to cut to the question of the moment within the tension of the market. What is the temptation to go to cash?
Well, it's a huge one. It's the highest yield on the curve is at the front end. We don't have depressed equity markets. The Federal Reserve has been tightening for a couple of years, and so that's really drawing a lot of interest. And again, is it going to be something that's going to outperform over the long run, you could take a look at the history of cash, and it really lags behind both bonds and especially growth assets, equities. And in terms of having a portfolio, you don't want, again, to sell your family business over what can be a yield that usually lasts maybe 6 months at its peak level before the Fed cuts.
Steve, moments from now, Chairman Powell's going to walk out here and, to Tom's point, stare and point at some mountains, and then we'll all listen to him speak in about 30 minutes from now. Steve, from your perspective, from people you speak to, are expectations high for him to say anything at all later on this morning?
No, expectations are not high, or I would say there aren't very strong views as to what he would say. Obviously, he's not going to say, well, we're going to let our guard down on inflation. That's not going to happen. But apprehension, anxiety over the possibility that you learn something that you're not positioned for, that creates trouble for investors. And one of the things you can see right now are record high levels of short positions in futures and 10-year notes and 2-year notes. It's a lot like where we were in the equity market at the beginning of the year. We see a lot of shorting of bonds right now. And again, we could end up seeing some relief after all of that apprehension ends, regardless of what he says.
Steve, there was a big question yesterday about the move in NVIDIA, and this question reigniting by Michael Hartnett of Bank of America about whether we're seeing tech stocks become interest rate sensitive again. Suddenly it matters that yields have climbed as much as they have. Do you think that that's going to be a more predominant narrative yet again over the next few months?
Look, interest rates will always matter. Whether or not it becomes the predominant issue depends on other fundamentals going on at the same time. I'd bear in mind that when you have, companies that have doubled, that have tripled in the year, okay, well, you don't think that they're going to be raising their earnings and their guidance and this sort of thing for companies that have become really huge. I mean, the Magnificent Seven U.S. tech stocks have accounted for something like 70% of the whole total return in global equity markets this year. So that concentration issue, that level of positioning, these things have become important. And if you give them higher interest rates on top of that, that can be an excuse.
How have you shifted over the past couple of weeks when we've had this roller coaster of emotions, soft landing, basically baked in, given, suddenly maybe it's too strong, maybe we have too much dynamism, rates are going to go up much further, and that's going to curtail some of this. Have you shifted any of your positions or beliefs during all of this time?
So for the U.S. economy, we are getting upside surprises. We're seeing that this year's growth rate is going to be stronger than last year. But I think everyone who believes that the economy can somehow escape any slowdown, or the labor market, which has outperformed the economy so much, can escape any slowdown in the coming year, I think that that's going to be the wrong point of view. And in fact, I would expect Chairman Powell to reflect on the fact that consumer finance rates have moved up a great deal. Not only that, the number of banks who are lending in the economy and doing so the way they did a couple years ago has changed. So monetary policy has tightened a lot. I do not in any way believe that these lags in policy have disappeared. Markets may be fast, but the economy is still slow. Now, I would say there has been some good news. We are working down the need to have a recession. What I mean by that is we've been able to keep employment and services growing for so long that it's supporting goods demand, that we're getting inventories down. That's usually the kind of thing that happens when we're coming out of a recession. So in many respects, I think the declines that you see that are very real in housing and manufacturing, we've managed to take some of these losses of recession already. Our outlook for next year is 1.8% real GDP growth in the U.S.
Stephen Whiting, everyone at this time, the complexity, the tensions of the moment, everyone turns to the Citi Surprise Index. What does the Citigroup Surprise Index tell you right now?
Well, it's showing remarkable strength, upside surprises, but they're wearing off a little bit. Once everybody has adjusted their view higher, it's harder to keep them surprised. Now, if you take a look at China or the European Union, we're having big downward surprises, and everyone adjusts their views to that. And so it's never static. If we take a look at the next year, we can never assume that these surprises really continue and that you're going to have just a static view of outperformance of the U.S. economy. That's something I'd be cautioned a little bit about. Now, that's even as we do think, again, just as I said, the American economy can probably have rolling recessions, take its losses in some sectors, and because of the instability of the last few years, actually grow slowly below trend for a couple years and get through this without a collapse everywhere. But again, I make one little point again for the Fed. In a period when they've inverted the yield curve, where they've tightened this much, the potential, the vulnerability to an outside shock is higher. And we saw this again 18 and 19 after policy has tightened and COVID came along. I don't want to say too much about that, but again, the possibility of having to absorb a shock with tight policy is something that you'd want to be aware of.
Steve, none of us want to talk about COVID either. Now, forgive me, away from here, the most important development in the last 24 hours is not anything anyone's got to say around here. It's about what happened with NVIDIA. They come out with earnings, Steve, they knock it out of the park, and I know you can't do single names, but surely you have to take some signal away from the earnings, which were fantastic, and the way the market responded to it, which was less than fantastic. What's the takeaway from that, Steve?
So John, you cut out for a second, but I think I'm going to try to answer your question, hopefully appropriately. We have just made moves into U.S. equities, specifically in equal weight indices, to not build up our concentration in the Magnificent Seven. That, again, wonderful companies that grow their earnings extremely well, and when they sell off sharply, if they have secular power behind them, you want to buy them. But when they have already galloped higher and generated so much return and such a massive market cap, we don't want to increase our exposure again and double up exposure in companies that have succeeded so much in the marketplace this year.
Steve, thanks for dropping by. It's good to catch up as always. Steve Whiting there of Citi Global Wire. Steve, thank you. You know the cheat guide to interviews, TK. You hear something you don't like, you didn't hear it.
No, it's great. It's great. I think our guests do better when they can't hear our questions.
What was that? NVIDIA? What? Single names? No. Yeah. Single names? What? NVIDIA? No. You cut out, John.
Do you know, with a global audience today, with all that we're doing here at Jackson Hole, Mrs. Bramo emailed in.
What did she say?
She said, let's go to Walt Disney. Born on a mountaintop in Tennessee, greenest state in the land of free, raised in the woods so he knew every tree, killed him a bar when he was only 3.
All right. That's right.
Davy Crockett.
My mom was correcting my correction of you, saying bar instead of bear.
Bramo.
Yeah, that's just no.
When Tom says bar, do you really think we're thinking bear?
Exactly. Do you think that anyone, you said, like, I was looking for a bar.
You were looking for a bar. I'm like, yeah, what's new?
No,
I'm not thinking bear.
He's like, wait a second, I was cutting out.
It's actually pretty serious up here, Lisa. You were out hiking around. I took a hike too.
Yeah, how far?
But there's signs up, and what's interesting is some of the signs have, like, magic marker on them. It's a mom with cubs.
Yeah,
we're not kidding.
Don't mess around with that.
And it's serious. Up at Jellystone Park, the people are taking the kids and they're going right up to the bison. You don't do that.
No.
I mean, I don't know what these people are thinking.
Tourist, TK.
Yeah.
Tourists. We're at one with our environment, a TV studio. Coming up shortly, Chairman Powell, 10:05 Eastern Time, 8:05
so
local.
It's like 20 minutes away.
20 minutes away, TK. We've got the clock ready to go. The
Yeah.
clock is ready to go. Chairman Powell just around the corner, and responding to that, Mohammed Al-Arian and Michael McKee. Looking forward to all of that. And Tom, in just a moment, Christina Roma.
She's expert on the Depression. If you have fears of our history, she is the expert.
The former chair of the Council of Economic Advisors. That conversation up next. Your equity market higher by 0.4%. From Jackson Hole, this is Bloomberg.
When we talk about monetary policy, what I said is that we have to be stubborn here, even more stubborn than inflation. This is what we have to do. This is our mandate. We have to bring inflation down to 2%. It's, for me, much too early to think about a pause. I think we have to wait for the next numbers.
Joachim Nagel of the Bundesbank, the president, speaking to Michael McKee. This is a single mandate central bank. It has an inflation target. It is not the Federal Reserve. Right. It's the ECB. And that ECB in the last 12 months, Tom, dare I say, has looked a lot more like the Bundesbank than it did under Mario Draghi in the previous decade.
That was brilliant. You're expert on this, John. I'm going to be speaking with Christine Lagarde. And within an academic conference, folks, I can't say to her, what are you going to do September 16th?
You can.
So instead, I'm going to go to John Ferro and say, John Ferro, what is the ECB going to do do September 16th.
They're in such a tough spot. I don't know. I really don't know. The backdrop for them is so different to the United States. We have really robust growth. If they had robust growth, I think they'd probably hike again. I think they would, but they don't. They have parts of the economy facing recession, Tom. Inflation's still sticky. The nightmare word in the last 18 months was stagflation. You certainly can't throw that around in the US economy. I think you can start mentioning it in Europe, and they hope they don't get stuck there.
Then how do you, and it won't be discussed here, but how do you overlay a war in Ukraine with conventional monetary policy?
I don't think you
understand.
can. That's what they've been facing. That's what they've been facing. Lisa mentioned this, and Lisa, when you said it, I think you're just dead on. The fact that things are so fragile over there that you can see something like a strike in Australia sending European gas prices through the roof all over again. That's how vulnerable they are to outside forces. And not just that, China's another great example of what's taking place in the European economy at the moment. And the US, I think, has the luxury to speak differently about these issues. Europe does not. They do not have the insulation that the US economy has.
And one of the big existential questions here that has to do with that difference is where the fiscal impulse really played into that. The stimulus that the U.S. put into the economy during the pandemic that Europe did not, that is still percolating out into consumer spending.
We're going to have that this afternoon. Christine Lagarde, she will speak here after Chairman Powell. John, what, 15 minutes away on Chairman Powell?
17, something like that. Yeah, TK.
Chairman Powell will speak, and then Christine Lagarde will speak. She will answer questions here among the assembled, and then we are thrilled for Bloomberg to bring you our conversation with Christine Lagarde on her paper here, and maybe a bit on the European Central Bank. This is a great moment, and this is, first of all, there's Adam Smith in economics. The modern name for Smith is Romer. AEA did a survey, and there's like 42 economists, world-class name Romer. There's a laureate, Paul Romer, on technology, some guy named David Romer as well, and Christina Romer joins us now from Berkeley, iconic on the history of our nation's economics. I have to tell this story. It's one of the great stories. You're like 22 years old, you and David Romer, I don't even know if you were married at the time, and you literally flipped a coin at MIT over who would get Stan Fisher and who would get Rudy Dornbush?
It's true. Now, in fact, David thought he won, but it turns out I think I won.
You won with Rudy. Good morning, Dr. Fisher, I know, watching it this morning. You are definitive. What an honor I had to meet Anna Schwartz in the last years of our lives. Tell us the history, the prism of all the fears that our listeners and viewers have. This is going to be like the Depression. This is going to be a crisis. Do you feel that way?
I have felt that way in the past. Take me back to 2008, and knowledge of the Great Depression was strangely relevant. I don't feel that way now, obviously. I think things are going pretty well. We're getting inflation down, and the economy so far is holding up.
Are we asking too much of our central bank?
We are asking a lot. It's amazing they're delivering so far. It's way too early to declare victory, but they're threading that needle.
Rudy Dornbush would have talked about, if he was here, he died tragically, folks, of cancer far too early. If Rudy Dornbush was here, it would be a dollar-centric conversation. In your study of our slowdowns, how does dollar worry fold into this? Should we be afeared of a weak U.S. dollar or a dollar that loses sovereign ability?
I don't think so. I think I feel very strongly the dollar kind of follows from what we do on other policies. So I think the main thing we worry about is the Fed doing the right things? Is Congress and the President doing the right things on the fiscal side? Is our banking system sound? Those are going to be the fundamentals.
There's also a question in your study of the Depression of what the response will be from the U.S. government if there is some sort of downturn, the inability to stimulate further because of how big the debt load is, because of what they've done and where borrowing costs are. How much do you think that affects the likelihood of a recession when you look not next year or the year after, but down the line that could last a much longer period of time?
I think I'm not very worried about that. I'm worried, right? So just the high debt loads in general kind of limit the fiscal response. I've actually done research that shows that that's the case. Certainly was the case during the global financial crisis. And so we ought to get our fiscal house in order. So we've got both tools to use. I think the Fed has made it very clear they're not going to be afraid to raise or lower rates, if that's what the economy needs.
Have you ever seen deficits this large with unemployment this low?
Well, I mean, yes, right? Because big deficits tend to go with low unemployment. Think World War II, right? The last time we were at 100% was when we had this very, very low unemployment. So in the short run, it's good, right? So you're stimulating the economy. We talked about how that fiscal impulse early in the pandemic was really a big part of why the U.S. coasted through.
I've been dying to ask you this question. Everyone from the left and the right have talked about it. Can you make an analogy to the economic carnage after World War II, 1947, starvation, the Marshall Plan and all that? Can you do an analog to 1947 over to the double deflations that we saw in early Eisenhower? Should we worry about the deflations of the early 50s, that same analog?
I don't think so. I mean, there were sort of special things going on. There were price controls coming off with Korea. So I think that I wouldn't worry very much with that. I think we're in, a much more kind of normal. We've had inflation.
Oh, come on, Christina, half of America feels like they're flat on their back. I mean, we have the disaggregation. I mean, Meltzer would kill me for this. The disaggregation of the economy right now is appalling. Half of America feels like they're flat on the back. What is the public policy that we can prescribe for those people?
It's a tough one because I agree, inflation makes people really mad. And that is, I think it's why it's so important that the Fed, really get back to their 2% target. I think there's just no question on that. But there's also the case, if you look at the basic fundamentals, for heaven's sakes, the unemployment rate is 3.5. GDP has continued to grow. I think, yes, people are struggling. They're certainly struggling with the cost of living, but a lot of the fundamentals are good.
You sound very positive. A lot of people have. Are people here taking a victory lap?
They shouldn't. And if I had to guess what Chair Powell's going to do, he will not take a victory lap. He will be cautious. He will say we've still got a ways to go because everybody else is doing the victory lap for him.
You can feel a little bit of happy talk around here, can't you? It just makes me uncomfortable.
No, and I agree. I think that we don't know what's going to come. We have still had a bunch of monetary contraction come in. It's not really hit us yet, and it could.
Oh, you think it has? Because Bill Dudley, the former New York Fed president, is arguing to some extent that maybe those lags are shorter. We've seen them. Everything they've done's already hit us. You think it's out there in the distance into next year?
I think it certainly could be.
Interesting. Christina, wonderful. Thank you so much.
Were you with Dudley at Berkeley when he took his PhD?
Were you there?
We're trying to wrap that up there, Tom.
I can just see the fist fight.
Thank you. Just say it.
Thank you.
I can just see the fist fight.
It's just this thing called a commercial break.
She's got claws. She's tough.
He didn't hear. His IFB went out.
Oh, is that what he did?
Yeah. That's what happened.
Selective hearing.
There's a bar over there.
Always.
Yeah, what do they serve at the bar?
I'll do it for a fourth time. Christina, thank you. Christina Roman of UC Berkeley. Appreciate it. Thank you very much. Your equity market's just about positive on the S&P 500. 10 minutes from now, Chairman Powell in Jackson Hole, Wyoming, addressing, I would say, not just this audience, but the global economy as well, Wall Street and beyond. Tom, a very, very different speech is expected from the one we got 12 months ago.
Well, a different speech from 12 months ago, John. This is a different speech from 4 weeks ago. I feel like I've never seen in Jackson Hole. Things have changed. Even back to 2009, back to Lehman, things have changed in 4 weeks.
Chairman Powell in the next hour on Bloomberg Surveillance, live from Jackson Hole. Good morning.